A single percentage point. That is all. Just 1% difference in your mortgage interest rate can cost you or save you over $40,000 across the life of a standard home loan. Most buyers never realize this until it is too late, and they have already signed on the dotted line. Welcome to Realty Pulse. In the next 10 minutes, you are going to understand exactly how mortgage interest rates work, why they move the way they do, and what the banks are never going to volunteer to tell you. We will cover where rates come from, what actually drives them up or down, and the one factor that influences your personal rate far more than the Federal Reserve ever could. That last part surprises almost everyone. Let us start at the beginning. Mortgage interest rates have been part of American financial life since the early 20th century, but the modern mortgage system as we know it really took shape during the Great Depression. Before the 1930s, most home loans required a 50% down payment and had to be paid back in full within 5 years. That is not a typo. 5 years. The entire loan. When the economy collapsed and millions of Americans defaulted, the federal government stepped in and created the Federal Housing Administration in 1934. This agency introduced the long-term, fixed-rate mortgage, the 30-year loan, which transformed homeownership in America forever. For decades after that, interest rates were relatively stable. Then came the 1970s and 1980s. Inflation exploded, and so did mortgage rates. By October 1981, the average 30-year fixed mortgage rate reached 18.63%. Think about what that means. On a $200,000 home loan today, that rate would cost you over $3,000 per month in interest alone, before you even touched the principal. The comparison to modern rates puts everything in perspective. So how does a rate actually get set? This is where most explanations go wrong, because they jump straight to the Federal Reserve and stop there. The Fed matters, but it is not the whole story. The Federal Reserve sets something called the federal funds rate, the rate at which banks lend money to each other overnight. When that rate rises, borrowing becomes more expensive throughout the entire economy, and mortgage rates tend to follow. When it falls, mortgage rates often come down as well. But here is what nobody talks about: the Fed does not set mortgage rates directly. There is a gap between Fed policy and your actual mortgage rate, and understanding that gap is where the real knowledge lives. Mortgage rates are more directly tied to the yield on 10-year United States Treasury bonds. When investors feel uncertain about the economy, they pour money into the safety of Treasury bonds. High demand for those bonds drives their yields down. And when Treasury yields fall, mortgage rates tend to fall alongside them. The opposite is also true. When investors feel confident and move money out of bonds into riskier assets, Treasury yields rise, and mortgage rates rise with them. This relationship between bond markets and mortgage rates is one of the most important financial connections most homebuyers never learn about. Now layer on top of that something called mortgage-backed securities, or MBS. Most mortgage lenders do not hold onto your loan after they issue it. They sell it on the secondary market, bundled together with thousands of other mortgages into investment packages. The biggest buyers of these securities are institutional investors, pension funds, insurance companies, and foreign governments. The appetite these investors have for mortgage-backed securities directly affects how competitive lenders need to be with their rates. When demand for MBS is strong, lenders can offer lower rates. When demand weakens, rates climb. Here is where it gets deeply personal. Everything we have discussed so far applies to the general rate environment, which you see advertised on bank websites. But the rate you are actually offered is a completely different number, shaped by your individual financial profile. And this is the part that can genuinely change your life if you pay attention. The single biggest factor in your personal mortgage rate is your credit score. According to data from MyFICO, the difference in the rate offered to a borrower with a score above 760 versus a borrower with a score between 620 and 639 can be as wide as 1.5 to 2 full percentage points. On a $300,000 loan over 30 years, that gap translates to a difference of more than $100,000 in total payments. Your credit score is not just a number. It is a price tag attached to every major financial transaction in your life. Your loan-to-value ratio is the second major variable. This is simply how much you are borrowing compared to how much the home is worth. If you put down 20%, your loan-to-value ratio is 80%. A lower ratio means less risk for the lender, and lenders reward lower risk with lower rates. This is exactly why buyers who can manage a larger down payment almost always access better loan terms, not just because they borrow less, but because the rate itself improves. The type of loan you choose also shapes your rate significantly. A 30-year fixed mortgage carries a higher rate than a 15-year fixed mortgage, because the lender is locked into your rate for a longer period and takes on more risk over time. An adjustable rate mortgage, commonly called an ARM, typically starts with a lower introductory rate that can change after a set period, often 5 or 7 years. ARMs can make sense in specific situations, particularly when a buyer knows they will sell or refinance before the adjustment period kicks in. But they carry real risk if life does not go as planned. Now let us talk about something called mortgage points, because this trips up a lot of buyers. 1 point equals 1% of the loan amount paid up front to the lender in exchange for a lower interest rate. On a $400,000 loan, 1 point costs $4,000. In return, the lender might reduce your rate by 1/4 of a percentage point. Whether buying points makes sense depends entirely on how long you plan to stay in the home. You need to calculate your break-even period, how many months of lower payments it takes to recover the upfront cost. If you plan to sell before you break even, buying points is a losing strategy. But here is what nobody talks about: most buyers never even ask about points. They accept the first rate they are quoted and move on. Shopping multiple lenders is one of the most impactful things a borrower can do. Research from Freddie Mac found that borrowers who get 5 mortgage quotes save an average of around $3,000 over the life of their loan compared to those who only get 1 quote. The lender you choose is not a formality. It is a financial decision with decade-long consequences. Refinancing deserves a moment here as well. When rates drop significantly below what you are currently paying, refinancing allows you to replace your existing mortgage with a new one at a lower rate. The traditional rule of thumb says refinancing makes sense when you can drop your rate by at least 1 percentage point. But that guidance is too simple. The real calculation involves closing costs, how long you plan to stay in the home, and how your loan balance has changed since origination. In a falling rate environment, refinancing at the right moment can save tens of thousands of dollars. The broader economic reality is that mortgage rates will always move. They respond to inflation data, employment numbers, geopolitical events, and investor sentiment, sometimes all in the same week. Trying to time the market perfectly is nearly impossible, even for professionals. What buyers and homeowners can control is their credit profile, their loan structure, and their willingness to shop competitively. Those factors, not rate. Predictions, are where real financial outcomes are built. The key takeaways from today are straightforward. Rates are driven by a layered system involving Fed policy, Treasury yields, and mortgage-backed securities markets. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Realty Pulse for a brand new video every single day. We will see you in the next one.